It is surprising to report relatively resilient headline performance from world stock markets over the second quarter, even though the economic backdrop is increasingly challenging. The US S&P 500 index returned 5.4% over the quarter, delivering a year-to-date performance of 10.3% in sterling, despite the dollar falling in value against the pound. This appears impressive, but it masks the fact that the market has been driven higher once again by a small cohort of influential technology companies, so investors will have typically seen more modest returns in portfolios. Japan and Europe also finished the quarter in positive positions, but the UK started the quarter well before succumbing to pressure, finishing down 0.5%, though it remains 2.6% higher year to date. Yields in government gilts and corporate bonds have continued to rise, resulting in a further drop of value. The benchmark 10-year gilt yield has risen from 3% to 4.5% in just 3 months, as the Bank of England moved interest rates higher, including a half-point move last month that took the borrowing rate to 5%. It was appearing a softening in inflation would allow the bank to resist further breaking, but the UK's structural issues, in particular a pressured labour force, has meant inflation has fallen slower in the UK than elsewhere. And the bank continues therefore to talk tough. The ONS published wage growth rising plus 7.3% in the 3 months to May, and the bank is likely to be concerned by this. However, it does not appear that the anecdote for lowering UK inflation is simply raising borrowing costs, as there are definitely other issues that need to be addressed. This continued tightening will restrict household and business budgets, reducing overall demand in the economy. The bank's July Policy Committee stated that almost 1 million people will see their monthly mortgage costs rise by over £500 by the end of 2026, as fixed-term deals come to an end and consumers will start to feel the pinch. The world economy is clearly in a slowdown phase, but has so far escaped recession, but it is unlikely to avoid one. As always, investors should be prepared for and accepting of market volatility to achieve their longer-term performance aims that will eventually reward their patience, even though they may be tempted by the short-term draw of higher deposit rates that are available from cash deposits at the moment.